Greetings, everyone. This is Cathie Wood, CEO and CIO of ARK Invest. It is Employment Friday, and as usual, we're going to talk about fiscal policy, monetary policy, economic indicators, market indicators, and a little bit about innovation. But first, I'd like to talk a little bit about the macroeconomic and political backdrop. As we all know, the markets are in quite a bit of turmoil because of the tariff, what we thought were going to be negotiations, and I still think will be negotiations. But President Trump has taken a very strong line of argument here, and arguing that reciprocity is necessary to create a fair playing field out there. Now, we're all trying to get our heads around how exactly he we know how he calculated his version of reciprocity, but it doesn't seem to make very much sense. And things do feel a bit chaotic out there, and the markets are convulsing as a result. There's a lot of uncertainty. So I've been in Asia for the last couple of weeks, and as I've been going around, and as the tariff, the intensity of the tariff debate has increased, I've tried to cut through it in a way to say, because I believe this, we know that Trump wants a legacy. President Trump wants to be one of the greatest presidents ever. That's his objective, and he's not going to get there by throwing the economy into a recession and the stock market into a bear market. And we're verging on both of those now. So we're getting close to the line in the sand, where I think his negotiations will kick into gear and will be more productive than what we've heard recently. So that's the bet, and it's logical if we understand who President Trump is. But as I've been going around, I've said not only is that our bet, but we're seeing other reasons for the tide to change here. According to the Atlanta Fed's GDP Now survey, the economy contracted almost 4%. That's real GDP growth sequentially at an annual rate in the first quarter. That's a big drop. Now, a lot of that could be imports ahead of the tariffs, and surely that is the case. The offset, though, would be a lot of them ending up in inventory, so there could be a lag there. I don't know. I would say that in the second quarter, the likelihood of a negative quarter is increasing here just because of the amount of uncertainty. Well, we know that about 30% of the labor force is probably wondering if it's going to keep its jobs, or the people in the labor force are going to keep their jobs. Federal employees, now that's not the biggest part of government, but there is a trickle-down effect to state and local, and even to quasi-government jobs in the healthcare and education space. And that would account for 30% of the labor force, just wondering, worrying, and probably holding back on purchases until the outcome is clearer. We also have another swath of people, and these are more in the white-collar world, especially middle management, that is seeing middle management layers taken out in many companies. Certainly that's the case in the tech space. And artificial intelligence is part of the reason this is happening. Those left are becoming much more productive. And corporations, many of them, are starting to flatten the hierarchies. We're seeing it in tech. We're seeing it in some financial services companies. That's another swath of the labor force that is probably wondering, what about me? And of course, beyond that, we have uncertainty associated with potential legislation. Tax cuts, when will they be effective? Now, the good thing there is this administration, if it holds to its word, is saying that it will make tax cuts, not the ones tax cuts, any new tax cuts, retroactive either to January 20th, the inauguration, or the date of the legislation. Nonetheless, there is still uncertainty, and it could be that small businesses and other businesses are deferring the recognition of income until they figure out exactly what these tax changes are all about. So we've got a lot of reasons for the velocity of money, and I've talked about this before, the velocity of money to slow down considerably as people and businesses hold back on their spending out of fear of losing jobs or out of anticipation of better tax rates sometime in the future. So a lot of uncertainty, but with 2 down quarters in GDP, we believe that the Trump administration and the Fed are now going to have more degrees of freedom to do what they want in terms of stimulating the economy. Now, the tariffs are certainly not in that category, and we do need clarity there. I know that President Trump wrote The Art of the Deal, and I know that throwing things into chaos is part of striking deals and getting to better outcomes. But I do feel, and the markets do feel, that President Trump might be playing with fire here. And today, China's retaliation, 34% tariff across the board for all U.S. goods, is an indication that that might be true. Now, China says that tariff will be effective April 10th. And of course, the tariffs that President Trump has proposed and has decided to put in place, the first will be put in place, the 10% across the board, Saturday, April 5th. The second set, so that's across, I think, 185 countries. A third of those countries will have a second set of tariffs as President Trump tries to veer towards reciprocity. And he knows exactly what that means, given the numbers he threw out there, which were somewhat confusing. So those go into effect April 9th, the day before China's tariffs on the U.S. go into effect. So I think there's going to be some serious negotiation. There already is. We know President Trump has said that he and his team are talking to many, many nations. But you'll notice each time that he does come out and say something about the tariffs, he will quickly follow up with, we're moving into one of the strongest economies with one of the best stock markets, and everyone's going to get wealthy. He'll have to, words are going to start to ring hollow unless these negotiations bear fruit and things settle down on the tariff front. So one of the things that I've also been trying to communicate, and I will do this with the slides now, is that we've been in a rolling recession since the Fed started raising rates in 2022. And we'll get into that in a little bit. But if we do end up with two back-to-back negative quarters, many investors might fear that, oh no, this is the beginning of a recession, and recessions usually last quite a long time. That's why it's so important to identify what this is. It's actually the end of a rolling recession. Now, what has kept the GDP numbers up in the last few years? High-end consumer and government spending. And both of those are about to change. So we think that we'll have, and in fact, they're in the process of changing as I speak. So I think that it will be the end of the rolling recession, and we'll have a clean slate to move into the future with what we believe could be a very strong productivity-driven recovery and then expansion. The technologies around which we've based our research and investing, they've been germinating for 25 years, some of them, and now they're moving into prime time. And when people and businesses are scared, they're willing to change the way they do things. And we think that will accrue to the benefit of robotics, energy storage, AI, blockchain technology, and multi-omic sequencing, and to the convergence among those platforms and the 14 technologies that underlie them. So one of the analogies as we're going through this market turmoil that I'm using, because it does feel very much like this, this is how it felt when we were going into COVID. And you remember there was a month-long deterioration in the stock market, fairly significant, fairly severe. And at the time, we were saying, wait a minute, who's going to solve this problem? It's the innovators. Who's going to sequence this coronavirus? Who's going to use synthetic biology to develop tests so we figure out if we have this coronavirus? Who's going to develop the vaccine? And of course, those companies were in our portfolios. And I feel the same way now. A lot of businesses, a lot of consumers are fearful, and they're going to be looking for better, cheaper, faster, more productive, more creative in terms of products and services. And so we have high hopes that when the new leadership shows itself, and typically if we are in a correction or a bear market, towards the end is when we see new leadership. I remember very clearly in 08-09, the market did not bottom until March of 09, and our strategies started outperforming in November of 08. This is what typically happens as the market looks to the new leaders. We know the Mag 6 had an extended stay, and we think part of that had to do with, their huge cash cushions and strong cash flows, and that's all the market was looking for in a period, especially starting after 08-09. That concentration towards the Mag 6 hit epic proportions recently. And we don't think they'll be the new leadership. Some of them will participate for sure, but we do not believe they'll be the new leadership in this market. And we do believe that if the market broadens out to more and more stocks, then this bull market that we've been in which we would have considered, with just a few stocks really leading the way, to be not an ideal or not a very healthy market. If we get more stocks participating, then that's a bull market that we will call healthy. Okay, so let me go into the charts now, starting with fiscal policy. All right. So here, I've seen these charts for years and years and years, but I didn't realize that we had hit, from a public debt as a percent of GDP, that we had hit the peak we reached in World War II. In the 2000 timeframe, there was the thought, could we be heading, in the tech and telecom bust, could we be heading towards that level? But here we are. And, that was a crisis time, and the country really did pull together after that to get the debt as a percent of GDP down. It did it in two ways. More control over government spending. Of course, we weren't in the war anymore, so that was a big source. But also on the GDP side, rapid growth. Post-World War II, very rapid growth. DOGE, we think, is an attempt to pull us out of a quagmire, it seems, in terms of government spending. It's what held the economy up, or real GDP up, along with high-end consumers during the last few years. But this is certainly excessive as we see it now in context. And you can even see in the 20s, in the 20s and 30s, we didn't get anywhere near this level. Another look at the budget, and you can see total outlays as a percent of GDP, around 24%. Now, what is not clear from this chart, but I do know, having studied this, is that receipts tend to top out in the 17 to 20% range. If the government tries to tax people any higher, they figure out ways around it. They either stop working, or they do a lot more under the table. I don't know what it is exactly, but that receipts as a percent of GDP rarely goes above 20%. So this deficit is structural. And I do believe that with DOGE and with more rapid GDP growth, we could move back into the period like the 90s. That was the last time we saw a surplus, and it was under President Bill Clinton and Newt Gingrich, who was a powerhouse in Congress, and they worked together to get that done. We do not have as much of a bipartisan situation right now, so we'll probably have to do more on the rapid GDP growth side of things. And if we're right, if deregulation, tax cuts, lower interest rates are what we're going to see as the government has more degrees of freedom during negative GDP quarters, then I do think we'll see much more rapid growth in the months ahead, months and years ahead, I should say. Onto monetary policy. Here I've presented this a number of times. It does seem like CPI, which is in the green there, is kind of stuck in that 2 to 3% range. Now, there are other measures of inflation out there that are saying something different. There's a measure called Trueflation, and we'll have it for you in the next, I think we're going to subscribe to their service, so we'll have it for you in the next package, or in the next In the Know. it is saying that inflation is down to 1.3%. And this is a real-time measure of, I don't know, I used to say millions of products and services, but I think it's more like tens of thousands or thousands, but real-time, constant monitoring. And it peaked at 11%, just about the time that the CPI peaked around 9%. It is now down to 1.35%. And as you may also notice, the oil price seems to be under severe pressure because Saudi Arabia is opening the floodgates. Purportedly, it is railing against Kazakhstan and Iraq overproducing and is just opening the spigot. There could be other reasons. Part of the negotiating out there, President Trump, I think, is with Saudi ministers this weekend, maybe even MBS himself. And there may be, and as he's been very vocal about getting oil prices down. So that may be part of what's going on here as well. Of course, the third variable is weakness in the economy. So all of those accumulating, which is going to take that trueflation measure of inflation down even further. So we've often said we would not be surprised to see deflation. And you can see we have seen it at times in the past, certainly in COVID and in 2015-16, when there was a lot of fear, a lot of volatility in the market, and a lot of fear about China imploding. So this is the picture of velocity, the velocity of M2 on a year-over-year basis. It peaked at 11% and is now down to roughly 1.5%. This is a fourth quarter number. If we're right, and there's there's seizing up in terms of spending, just holding off until the coast is clear, whether it's tariffs if you're a business or a person's job. Is that person going to keep his or her job? Until the coast is clear, there's going to be a bit of a pullback in terms of the rate at which money turns over, the rate of spending, velocity. And with money growth on a year-over-year basis of only 3.9% as of February, that's a February number, if velocity turns down on a year-over-year basis, which we do believe it will, there will not be much room for nominal GDP growth. If money's around 4%, and velocity starts to fall on a year-over-year basis, it is falling sequentially. It fell in the fourth quarter sequentially. Then that means that nominal GDP growth, mathematically, this is just math, will be below 4%, dropping from its recent 5% level. So now I'd like to show you some charts. I mentioned high-end consumer. It had been faring pretty well and had been spending. But you can see on this next chart that after holding in, consumer sentiment of high-income earners, so that's the purple line here, capitulated in March. And you can see that low and middle income have been, the sentiment levels there have been very low. And take a look at where we saw this kind of mood historically. It wasn't even this bad during COVID. You have to go back to 08, 09. So the mood out there is pretty grim. And I think this crack in high-end consumer sentiment is one of the reasons we'll see a negative GDP quarter in the second quarter as well. So let's get to other evidence of a rolling recession. So the high-end consumer kept the GDP growth positive. That seems the high-end consumer is not feeling as confident and probably will not be as strong a force. Here you can see in 2022, this is what I mean by rolling recession. You can see existing home sales cracked then and really have not recovered. So that's definitely part of this rolling recession. But you can see we're at 4 million units. And, in the late 70s, this was at 5 million. And the population's a lot bigger since then. So, and you can see the last recovery got us to 6.5. There's a lot of room to recover and huge pent-up demand if interest rates come down. People are trapped in their homes with low mortgage rates. If they have a 2% mortgage rate, the affordability of flipping into another home at 6 to 7% mortgage rates is problematic. So definitely housing has been part of the rolling recession. Now here's auto sales. Now you can see after COVID, or we had a spike during COVID, then we went down, and then we settled into some subpar 15, 16. Very recently, to get ahead of tariffs, auto sales got a bit of a burst. If auto analysts that we follow are correct, this is now going to correct down to 14 million. So that will be part once tariffs go on, that will be part of a negative GDP quarter as well. Small business optimism. Here you can see it looks like, oh my gosh, there's been a surge. That was the election. And it has started coming down. I know we get another reading next week. My guess is that this optimism index is going to plummet again because of all of the news out there, the rebel-rousing tariffs, and just business not doing really well. And here again, look at where small business, it dropped right after those rates went up and went down also to levels that that were consistent more with 08-09 than other recessions in shaded areas that you can see here in the 90s and 2000s. So small business has been feeling pretty low, and understandably so. It was very hard to get credit, interest rates so high. High hopes coming out of the election and maybe before the inauguration, but given how tumultuous the markets have been, I think this will come down again. Here you can see other evidence of rolling recession. The green line here is the manufacturing PMI, and you can see it started going down even before rates went up in 22 in response probably to too much inventories built during the supply shock when companies were double and triple and quadruple ordering. And you can see this measure has been below 50, which means the manufacturing sector has been contracting in the U.S. For several years. It popped up 1 month and now is coming back in. The purple line here is U.S. Manufacturing as a percent of GDP. And you can see one of the reasons President Trump is determined to bring manufacturing back to the U.S. Many people say it'll be a fool's game to do that. Because compensation costs here are so much higher, and it will just feed inflation. We have a different point of view on that. We believe that automation with robots, soon more and more humanoid robots, AI is going to be fertile ground to bring manufacturing back. In fact, it reminded, as manufacturing here in the United States was being gutted, and it went to China, we began to think, okay, how could this reverse? Well, if you think about what happened to China in telecommunications, it did not have a landline system. So it went directly to wireless and became a mobile-first economy, and also leapfrogged us in the digital wallet space. Again, mobile-first. Our financial rails were good enough. It did not have a physical bank branch system. And so it went directly to mobile first and leapfrogged us. We're just now moving more into mobile payments in a big way here in the U.S. and in other countries. Well, what if the payback for the last 25 years of losing manufacturing is we leapfrog China and other countries who have older manufacturing techniques that are more labor intensive and go straight to automation, significant automation, and really it is something we expect, and we do think it will drive significant productivity in the years ahead. So we're more hopeful on that score, to be sure. And more on the rolling recession here. This is year-over-year change in capital goods. It's new orders for non-defense equipment, aircraft and parts on a year-over-year basis. It took a while, but the capital spending has been going nowhere. It's been flat for a good year. And if we're right, given all the uncertainty out there, it could tip over here. So this one is feeding into that rolling recession argument as well. Now we're on to more market indicators. So Bloomberg's commodity price index. We did this chart earlier this week. I think the Bloomberg commodity index has dropped back to 100, and probably will continue to go down if our economy is as weak as we think it is. But as I always like to highlight, the Bloomberg commodity price index is today where it was in the early 2000s, in the early 90s, in the early 80s, which from an inflation concern point of view helps put where we are in perspective. The real inflation was in the early 2000s. For some reason, it didn't get through to the broad-based indicators the way it did to commodity prices. But there is much less inflation now. And now we've got oil prices, the most visible, cracking on us. Here, metals to gold, the purchasing power of gold has continued to go up, as you see in the purple line. So metals relative to gold. When this line is going down, the purchasing power of gold is going up. Gold can purchase more in the way of metals at a given price. Now, this chart doesn't show what has happened today. The 10-year Treasury bond yield did drop below 4%. If we're right on what's going on here, the 10-year Treasury bond yield probably will continue to come down. I know a lot of people speak about China and other countries disgorging our Treasury securities. And from a supply-demand point of view, that is happening, and it is a lack of demand relative to supply showing up. But there is a bit of a flight to safety going on right now. And there's also another phenomenon. I don't know how much it would have an impact on this, but the stablecoin movement, those are backed by Treasury securities. And while they're Treasury bills, I'm sure there are ripple effects throughout the yield curve. So the stablecoins are now up to 250 billion, and we expect them to go to 1.4 trillion in the next 5 years. So we would expect the pressure on interest rates in the near term here, certainly because of the economy, to be down, to go down. Bitcoin to gold. Gold has had a good run against Bitcoin. Bitcoin did very well relative to gold in 23 and 24, but not so this year. Nonetheless, we do think over time Bitcoin will appreciate relative to gold. And as you can see, it has not broken the uptrend line. Here is the S&P price relative to gold. This is an indicator that Charles Gove of GovCal is monitoring. And he would not be surprised to see the S&P fall as it did in the 70s relative to gold. We would be surprised to see that, especially if we're right on all of the productivity and pent-up demand that fiscal and monetary stimulus should unleash during the years ahead. And the productivity gains associated with it. On the other hand, he would have expected this metric to go down as well, but it is not. The S&P is holding up relative to oil. Oil, of course, is capitulating recently, as I mentioned, because of Saudi Arabia's recent decision. And just a few more charts here. 10-year Treasury yield, we did break the downtrend, and that was a 40-year downtrend. Probably in COVID got to too low of a level, and we would not be surprised to be in a range now for the next few years, 2.5% to 5% range perhaps. But if we see more deflation thanks to the new technologies that are evolving, we wouldn't be surprised to see it settle a little lower than 2.5, but clearly the burden of proof is on us on that one. Here is, from an economic point of view, something that should put all of our minds at ease, especially given all of the consternation about tariffs and the fear that the equity market seems to be exhibiting. The bond market, this is the high yield spread. It's the spread of high yield interest rates relative to Treasury rates, or yields. I should use yields because these are long term. And you can see, while the spread has gone up, and if you looked at it at just a 1-year basis, it has gone up, I think, from 2.6 or 2.5 to roughly 4%, maybe a little less than that. In the context of history, this does not look like a big deal. And so the bond market is not as worried about the stock market, and the bond market tends to worry more about the stock market, more than the stock market, or earlier than the stock market. That is not happening this time. And then finally, just the yield curve. I always like to go back to this and, marvel that even though the monetary and fiscal authorities around the world threw everything they had at COVID, the yield curve could not get back to the steep levels it has seen during past fiscal and monetary stimulus moves. And I just think there is more of an underlying deflation message here. although at the same time you would expect to see high-yield bonds being more jittery if this is indeed the case. So we're still wondering about this one. We know there's a message here. The downtrend is still in place. And maybe the message is, and just to end up on innovation, maybe we're going into a time just like the 50 years that ended in the late 20s when telephone, electricity, internal combustion engine were coming of age. And during that time, we were on the gold standard, so there was really no inflation problem. There were boom busts, but inflation was essentially zero when averaged out. But there was a deflationary tendency associated with these new technologies. So the yield curve was inverted. Even during the best of times, it was inverted most of the time and at an average of 100 basis points. So that would be taking us down to where we were just a couple of years ago, 100 basis points on average, with inversions as significant as 500 basis points at times. So we're looking for clues that we might be in that same kind of period, and what you would see is the short rate being influenced by very strong GDP growth associated with these new technologies, certainly on the unit growth side, and the long bond being influenced more by the deflationary undercurrents that were associated with these new technologies. And of course, we were on the gold standard, so it was not an inflationary world. So with that, I know it's been a tough week for the markets, and in Asia, I've been talking to a lot of people, and all we've been talking about is tariffs. And I realize that I don't have a lot of answers. All I know is that if Trump is on the mission that I think he is, to be a record-breaking president in all kinds of positive ways, that's his intention, then he is behind the scenes negotiating to get deals done to the benefit of the United States, and maybe in more of a win-win way than he suggested in the Rose Garden this week. So that's where I'll leave you today, and we'll see you next Employment Friday.
节目最后，如果本期资讯对你有所帮助，请您点赞、评论、订阅并打开小铃铛，这样您就不会错过本频道的最新内容。谢谢。